Hi, this is Kurt Frankenberg with RadioActive Trading, and I'm here to talk to you today about performance, specifically the performance of the Fission portfolio. Now, Fission was a response to subscriber demand, where instead of doing trades and then taking money out and using it to live on, we were asked to put money into an account and not take any out and not put any more in, but simply trade the radioactive trading methods for a period of time and track the results. And we've done that. Now, May 1st, 2007 is when we got into doing Fission for our subscribers. And during that time, we've tracked the performance of the S&P 500. If you had gotten in on May 1st, 2007, let's say you bought the index SPY that tracks the S&P 500. Well, you would have paid $150 a share back then and only been able to take out 106.72 today. That's a 28.8% loss. That $100,000 would be down to $71,200. Well, that's not what happened to the Fission account. The Fission account is actually up. Here's a snapshot of the Options Express account, and it shows in the last few trades a gain or loss. The gain is 766.14. The cash that we have on hand is $27,000, and the account value, the cash plus all the positions, I'm not showing the positions of course, but the cash plus all the positions is $103,175.43. That's after a couple of years of trading through the worst bear market in recent decades. And we're ahead. Well, how can that be? How can a system that emphasizes buying stock come out ahead even after such a terrible turn? Well, here's an example of how that happens. The answer lies in buying a put option to help shore up your account, to kind of hedge it. I started out here with SWN, for example, on June 11th, 2009, and Southwestern, the value went down, it came up a little, it went down, it came up a little again, it went down. It just did a serious roller coaster. This would have been a really emotional ride if I had not been trading it radioactively. Now this looks like a loss, doesn't it? But here's how we started out. I began with 200 shares of Southwestern, and at the same time picked up two January 2010 $50 puts. Well, guess what happened? The first thing that happens is the stock goes down, of course. Well, I sold to close those January $50 puts and bought to open January $40 puts to protect the stock in their place. That generated a net credit, and I used that credit to purchase more shares at a much reduced cost basis. The net position now still has a small amount of risk. It had 12% risk and less than 1% risk to my entire account. Well, next thing that happens is I pulled income method number 5, where you sell twice as many calls as you buy. On August 3rd, I bought two September $41 calls and used the funds from selling 4 August $44 calls to pay for them. Well, guess what happens? The stock goes down and expiration approaches, so those calls ended up worthless, but happy thing, I still own the September $41 calls. Now, as the stock goes back up, we're happy about the stock going back up, but we're double happy because I'm also holding 2 September 41 calls, which I ended up selling for a very nice profit and ended up closing this entire position for a 3.3% return when it should have been a 10% or worse loss. Okay, so this radioactive profit machine actually made money in the same time frame that the stock went down. RadioActiveTrading.com. Come there to get your free sketch, or if you want to buy the blueprint, that's available there too. The blueprint teaches 10 income methods. We've just shown you a couple of them. I like to say don't pick stocks. Pick stops. That's where we start, at a protected place with our put option. But then more importantly, don't time trades. My timing with Southwestern was lousy, but because of using the options and trading time, I did okay. Come join us every Tuesday and Thursday at 12 noon.